Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 27th of March 2022. Today we're going to discuss financial promises that have been made to all of us. Of course, I'm talking here about counterparty risk. This is defined as the risk that one of the parties involved in a transaction might default on its contracted obligations. How does that relate to gold? We often hear that gold is one of the few assets that doesn't have any counterparty risk. But is that really true? Well, look, if you hold physical gold directly in your possession, then absolutely there's no counterparty risk whatsoever. There are no contracts involved in that type of ownership. Basically, you hold it and you can do whatever you want with it, whenever you want. Also, nothing's required to maintain it in terms of maintaining its value. It represents energy that's already been expended. And so in this form, I think of gold as being one of the most straightforward and honest assets that are out there. You know exactly what you're signing up for. The problem is that there's only so much gold that you can hold in your possession practically. And so most people undertake the services of a custodian. And this can be for physical assets or electronic assets. Examples of custodians include vaults, banks, or brokerage firms. A custodian is responsible for keeping the assets safe. They often facilitate or process trading of the assets and they service the assets. So, for example, they might be collecting dividends. When using a custodian, your expectations are that these are the promises that they're making to you. Custodians are widely used, particularly because of convenience. Okay, so we all use custodians in some form. So what things do we need to watch out for regarding custodians? Well, the first thing to note is that the contract between you and the custodian has been drawn up fully by the custodian. Asset owners have no input and basically there was no negotiation involved. You either accept their terms or leave it and go elsewhere. It's a take it or leave it situation. Now, unless you have expertise in contract law, it's pretty tough for most of us to trawl through these kinds of contracts. Often they're pages and pages of tiny print. So it's hard to work out what exactly it means and what are the implications for you. So as a result, for most of these things, we just end up agreeing just to have access to the services that are provided. That reminds me of a stunt that was pulled in London in 2014. Here, people who requested to connect to a free Wi-Fi hotspot, whenever they did that, the usual terms and conditions box popped up. And interestingly, the small print included what was called the Herod clause. So let's have a closer look at that Herod clause. And this is exactly what it said. In using this service, you agree to relinquish your firstborn child to F-Secure, as and when the company requires it. In the event that no children are produced, your most beloved pet will be taken instead. The terms of this agreement stand for eternity. So, yeah, I mean, what if you don't have a kid or a beloved pet? I guess a kidney will do, eh? Anyway, the thing is that people actually agreed to this unknowingly. A clause that most custodian contracts have is the force majeure clause. And so here's an example here. So here it says that they're not responsible or liable for any failure or delay in the performance of its obligations, arising out of or caused by directly or indirectly forces beyond its control, including without limitations, strikes, work stoppages, accidents, acts of war, terrorism, civil or military disturbances, nuclear or natural catastrophes or acts of God, interruptions, loss or malfunctions of utilities, communications or computer, software or hardware services. Now, surely if you own gold, it's actually events like this that are your reasons for owning gold in the first place. Effectively, they are promising to look after your assets as long as all is well in the world. If the force majeure clause is triggered, the custodian can suspend their services to you, and basically you might have no access to your assets. And who knows how long that could last. They could even modify the contract, or they can terminate the contract. And basically there's nothing you can do about this. All you can basically do is be aware of the possibility and take that into account. Another thing to watch out for is sub-custodians. This is where a custodian employs the services of another custodian. And this is usually particularly needed when you're looking at different jurisdictions involved. But this isn't always the case, and sometimes there are cases where you've got chains of custodians involved. So you could have a custodian which employs a sub-custodian, which in turn employs another sub-custodian. And the problem is that you as the asset holder have no control over the length of that chain or the contracts and content of those legal arrangements. So where possible, it's best to minimise your involvement with companies that use sub-custodians, although that's not always necessarily that easy to do. Custody accounts also vary in terms of how the assets themselves are held. So ideally, you want your assets to be segregated under your name. Unallocated pooled assets are far from ideal, especially when it comes to precious metals. Common arguments people put forward in the defence of custodians include, oh, but it's fully backed by. So, for example, an ETF may say that it's fully backed by physical gold, but that's not really giving you sufficient information. Is it leased gold? Is the gold held by a sub-custodian or multiple sub-custodians, etc.? So there's lots of questions you can ask there. Another one is, oh, it's regularly audited. Well, so were Enron and Wirecard, and look what happened there. Oh, but this doesn't apply to so-and-so company because it's in this jurisdiction and they have strong rule of law. Well, recent events involving Canadian financial institutions illustrate how the law can change lightning fast. The other issue here is that nearly all of us have little or no idea what laws are actually in place right now, and the devil is in the detail. Some people get comfort in the thought that if something were to happen, then they can just sue the custodian. Now, a couple of viewers actually brought this up when we were discussing how Robinhood fiddled with the trading rules when that whole GameStop squeeze happened. The thing is that lawsuits take ages, and often, it's usually the winners are usually the side with the best lawyers and the most expensive lawyers, and that's usually the custodians, And certainly I haven't heard of anyone winning anything from that GameStop lawsuit that people had kind of got together to fight against. And so, look, even if the asset holder does end up winning such a case, it's only after a lot of time and work and effort. And during that wait, they may be stuck not having access to their own assets. In conclusion, I think it's very difficult to completely avoid counterparty risk. It's just not practical. What we can do, however, is understand the risks and try to minimise those risks. That could be achieved by things like diversity of custodians or avoiding custody chains where possible, etc. When it comes to looking after your assets, who do you mistrust the least? Next up, the market update. Well, not much has happened in terms of the precious metals. And so in terms of what I think is going to happen from here, I think there's two options that I'm looking at. One is that it'll either just keep going up from here, or the other one is that we're going to get a dip first before continuing a big leg up. And so the levels that we've been looking at, I spoke about last week. So I thought, let's not rehash the same things. And let's look at a few other interesting things going on. And one big one here is the US 10-year yield. And this is on the monthly scale, and I'll put it on the log scale as well. And we've been looking at this trend line, which has had multiple touches, one here, here, another one here, and another one here. So it's a pretty reliable trend line. And I've also got in blue here the 200-month moving average. And we had a big spike up in the yield, and quite a few people are kind of panicking, saying, oh, the bond market is about to break and so on. Look, I don't think we can say that until we've first of all broken through both the moving average and the trend line. But not only that, we need to really find support on that to give us extra confidence that that's the case. Now, I think that is going to happen, but I don't think it's going to happen just yet somehow. If you look at this 200-month moving average, obviously it only goes up to this point here. But all along, it's never really touched it except for over here. And it literally just touched it and bounced straight back. We haven't even touched it yet. So we have got a little bit further to go. I think we're looking at about 2.8% before we get to that. And so that is actually the area we want to watch out for. So yeah, I wouldn't be get too excited until we see, something happening there. And what could happen is what happened here. We could get a touch and then a turn back down. Now it doesn't necessarily have to go as low as this. It may just do something like this where we get a bit more sideways movement, and so it could be something like this for a while before we get the breakout. I don't know when that's going to break out. Maybe in a year, maybe 2 years. I don't think it will be as long as 2026 though. Somehow things are pretty unstable, aren't they? But yeah, let's see what happens here. But in order for us to say that the bond market is broken, we need something like this to happen. And I'm not convinced we're there quite yet, but it's coming. Okay, now the other thing that people have been talking about is yield curve inversion. So this is the US 10-year yield minus the 2-year yield. And what we're looking for is an inversion. So on this chart, we're looking for a dip below the 0 point here. Now that happened here and here. And that foresaw a recession that occurred around 2001, I think it was. And again, this happened in 2006, and we know what happened in 2007, of course. And we had a kind of tiny poke below it before turning over here. Now, interestingly, on the Federal Reserve website, they've got this here as being a recession, and they do kind of these vertical shaded lines, and it's a very thin shaded line. But I don't know if you can call it a recession if it's that short a period. Don't you need 2 quarters of negative growth to call it a recession? So yeah, I'm not sure what criteria they use there, but anyway, it basically signifies something important's going to happen, and it usually occurs in advance. But the problem is that it can be a few months. It could even be a couple of years. So it's been very reliable in foreseeing recessions occurring, but it's not very reliable in foreseeing when it's going to occur, you know, how long after the signal. Anyway, what we've noticed here is that this yield curve is kind of coming towards that inversion point, but it's just not there yet. And it might be that we get something like this again. If you recall from the previous chart, we might get something like that before it comes up. But yeah, another thing to watch. And I quite like this. This is on stockcharts.com, and this is the dynamic yield curve. And what this is you can actually move these lines across, and here it shows the yield curve dynamically. And so as you move it, this is actually quite, you can have it as an animated thing. I've just taken some screenshots just to show you what the yield curves have looked like in the past. So here we go from the kind of short-term yields to the long-term yields here. And you can see that these curves are kind of relatively flat. Of course, this top line here is from the 2000 inversion, and this is from the 2007 inversion here. So you can see that obviously the rates were much higher than they are today, and we got flat across the durations here. And so if we skip forward to the more recent curve inversion, which happened in 2019, and so that's this maroon line over here, and again it's relatively flat, a bit similar to the previous two that we mentioned, but currently look at where we are now. You've got this very steep short end here, and it's actually the longer end that's flat, and so that's what's different from all the previous times. And that's because basically the short-term rates have been kept low, and they're desperate to keep them low. So yeah, that's interesting to look at dynamically on that website. You can do that with the animations. US dollar index. So that's been quite interesting as well. What I've got here is the index on the daily scale. Those of you who have been here for a while will know where these black and orange lines have come from. Those are long-term trend lines, and that worked pretty well. So we had some movement between there. Now we've broken out above it. And what I've drawn here is this line here just above 100, because that's been shown to be some previous resistance. And so where we are now, I think we've still got movement around this area. And if you look here, you can actually draw a little trend line down here. And so that looks like it's on the verge of moving upwards here. And of course, if we look at the targets, I mean, this kind of looks like a little triangle here, doesn't it? So at least we've got this here as an initial target. So is that bad for gold? Well, not necessarily, because if you look down here, what I've got is the correlation coefficient between the US dollar index and gold. And most of the time it's actually negatively correlated, which means when this index goes up, gold goes down. But lately it's been very different. It's positively correlated, and it was quite strongly so up here when the index was spiking up here. And it's still positively correlated, even on the weekly scale. This is showing the case as well. And it's been in this positive area for a lot longer than it has previously, you can see here as well, which is interesting. So yeah, the dollar and gold can go up together. And finally, let's have a look at the gold-silver ratio. This is on the daily scale. And we looked at this before, where I'd drawn this channel by joining these highs and then bringing that down to kind of roughly join these lows here. It's not perfect down here, but it will do. Anyway, we've now entered that lower part of the channel. You can see that the mid part of the channel has been resistance here. And so it kind of looks like it wants to move down in this area. Now, we're not going to get massive fireworks in silver until we get below this level here. So we're looking at level below 73 to get some big moves in silver. Once we get below there, I think we're going to start seeing some interesting price action. And yes, so this is the HUI to gold ratio. So the HUI is a kind of gold miners index, and this, I quite like this one because it goes back a bit further than some of the other mining indices, I guess. And so what I've done is join these highs here, and you can see that it fits very nicely. We had some resistance over here and here. It's hit that trend line beautifully, and guess what? It's just hit it again. So when we break out above this, it basically means that the gold miners will outperform gold, which is something really, it's going to be something to look forward to, because of course the miners have suffered. They've been beaten down for quite some time, and I think a lot of people have just completely forgotten about them or given up on them. Now, it doesn't mean that this is going to go straight through here at the moment. I mean, there is a possibility maybe it might hang around here for a little bit before coming up. I guess that will give a bit of symmetry. If we've got this here, then that's a possibility as well. So we might have a little bit of a wait before we get that, but that's just going to be really exciting once that happens there. Especially actually if you look at it also, we've kind of got a double bottom over here, and so the neckline will be around the 0.2. So once we get above that, then we're looking at targets, you know, up here, based on the height of that pattern there as well. So a lot of potential there, and the downside is pretty small. Okay, so that's it from me. And it was quite interesting. Last week we were talking about various mistakes that people make, and one of them was not considering probability and risk. And it was interesting. So earlier this weekend, we were just out driving, and there was this guy who was on the road with on one of those electric scooters. So of course, he didn't have a helmet on, but of course he did have his muzzle on, just to be safe. So yeah, that's just an example of someone not really understanding probability and risk. Anyway, thankfully, all of you over here understand probability and risk very well, I'm sure. Right, well, we shall see you next week. Bye.